All right, let's jump right in. We're looking at a fascinating story today, a classic industrial company, Thermax Limited, standing at a huge crossroads. We're going to break down their really ambitious pivot into green energy, and we'll be using a recent equity report as our guide for a completely neutral analysis.
So here's how we're going to break it down. We'll start with where things are right now, then dive into the company's Thermax 2.0 vision. After that, we'll weigh the bull versus the bear case, and finally, wrap it all up with the investor verdict from the report.
Okay, first up, a critical inflection point. Let's see what the market's telling us.
So if you're just looking at the charts, this one from February 2026 flashes a bit of a warning sign. You can see that after a really strong run-up, the stock started to trend down. Right now, it's testing a really important level, that 50-day exponential moving average. You can think of that as a sort of a technical floor. And believe me, traders are watching this like a hawk to see if that floor is going to hold.
But you know, a chart is just a snapshot, right? It never gives you the whole picture. To really get what's going on, we have to look under the hood at the company's strategy. And that brings us right to our next section, the Thermax 2.0 vision.
And wow, this slide really lays it all out. What you're seeing is the core of their big shift. The MD and CEO, Ashish Bhandari, is leading this charge they're calling Thermax 2.0. It's a total pivot, moving away from their old-school business of industrial boilers and transforming into a green energy powerhouse. But here's the kicker, the number that tells the real story. 75% of their new inquiries are now from green categories. That isn't just a change, that's a seismic shift in where their business is coming from.
So this whole new strategy, it's standing on three huge pillars: industrial decarbonization, water desalination and recycling, and green chemicals. And let's be clear, these aren't just trendy new business units. These are what we call secular growth trends, massive, long-term global shifts that the company is hitching its wagon to for the future.
Okay, and a really key part of this whole plan is being the first one of the party in India's green hydrogen scene. They've been super smart about it, partnering up with global tech giants like Hydrogen Pro and Cirrus Power. This gives them what's called a technology-agnostic position. What does that mean? Well, basically, they're not betting on just one horse. They can use whatever tech is best for the job, which makes them super flexible and a go-to partner for their clients.
Now, this is where it gets really clever. The strategy isn't just about the products they're selling, it's about how they're selling them. They're moving to what's called a build, own, operate model. It's more asset light. The goal here is to create steady, predictable revenue streams, almost like a subscription service. And why is that so important? Because it helps them escape that classic painful up and down cycle you see in the capital goods industry.
All right, so that's the big vision. Now let's get into the bull case. What are the big arguments for why this whole thing is going to work?
And here's where the bull case really gets its legs. The order book. I mean, just look at it. The company is sitting on a record backlog. We're talking a 34% jump in order inflows. This isn't just some number on a page. This is the market giving a huge thumbs up to their green strategy.
Let's just pause on that number for a second. 12,641 crores. That is a massive number. It's not just an achievement, it's a pipeline stuffed with future revenue. It means they know where their money is coming from for a good while to come. So where's all this growth coming from? Well, it's a two-pronged attack, really. First, they're expanding globally in a big way. Half their new orders are from outside India, including a huge 580 crore deal in Nigeria. And second, they're jumping into hot new areas like data center cooling, where they've already snagged 200 crores in orders. Pretty smart.
And holding all this growth up is a rock-solid financial foundation. Check this out. An 80% growth in profit after tax in Q3 of FY26. Now, to be fair, that number got a boost from a one-time legal win. But even without that, the company's financial health is looking great. They're debt-free, sitting on a nice pile of cash, and that means they can fund their own big projects, like their goal for 1 gigawatt of renewable capacity without borrowing money.
Okay, so the bull case sounds pretty strong, right? But hey, there are always two sides to every story. So let's flip the coin and look at the bear case, the risks, and the things that could go wrong. All right, the first big red flag for the bears is all about margins, basically their profit on each sale. And the spotlight is on their chemical business, which used to be a real cash cow. As you can see, those healthy 15 to 17% margins have been squeezed down to around 13–14%. And the reason? It's a double whammy. Intense price competition from China, plus the cost of building new factories before they're fully up and running. And it's not just about the margins. The bear case has a few other worries. The big one, as this scale shows, is the premium valuation. In simple terms, the stock is expensive.
A lot of the good news and future green growth might already be baked into the price. On top of that, you've got some policy issues in the ethanol business, which used to be a growth engine. And then there's always the risk of messing up. I mean, managing these huge, complex international projects is never easy.
So there you have it, a powerful growth story versus some pretty serious risks around valuation and operations. How do you put those two pieces together? Well, that brings us to the final section, the investor verdict.
So what's the final call from the report? The verdict is to accumulate, especially when the price takes a dip. The thinking here is that you shouldn't look at Thermax as a quick trade. Instead, see it as a long-term compounder, a foundational piece of your portfolio if you believe in the whole decarbonization megatrend. The report expects earnings to get better over time and suggests that a good time to get in would be when those chemical margins start looking healthier again.
And that really leaves us with the million-dollar question, doesn't it? The long-term shift to a greener world seems like a sure thing, and Thermax has placed itself right in the middle of it all. But can they handle the short-term heat? Can they navigate those squeezed margins and that high valuation to actually deliver on the massive promise of Green 2.0?